Welcome to the Market Share and our 2020 Outlook. I'm Paul Gifford, Chief Investment Officer of FirstSource. Joining me later will be Rob Romano, our Director of Research, and Eric Clapsaddle, our Senior Fixed Income Portfolio Manager. As you know, for well over 100 years, FirstSource has partnered with their clients and helped them manage their investments through a Great Recession, Great Depression, and numerous bull markets. But before we get on to the 2020 Outlook, I'd like to take a look back over the last decade. If you think about where we started the 2010s, it was just coming out of the Great Recession. And at that time, we had unemployment at over 10%, and today it's down to 3.5%. We had mortgage delinquencies at 12.5%, and today it's at 2.5%. And when we started the economic expansion back in 2010, it's now at the longest period of time of growth in US history at over 120 consecutive months of growth. Some of the difficult numbers or more challenging numbers during the decade have to do with the US deficit and the US federal debt. The US federal deficit continues to be about $1 trillion a year, which is very unusual in this kind of economic expansion that we're experiencing. Second is the US federal debt continues to grow. Today, it's at over $22 trillion, up from $14 trillion just a decade ago. So those will be two challenges as we enter the next decade. The very good news that came out of the 2010s would be the investment performance in the markets. Let's start with interest rates. The 10-year Treasury has gone from 3.7% down to 1.7%. So clients have not only earned their interest, but also seen their portfolios appreciate on the fixed income side. Second, it's been a great decade, particularly for US equity markets. The Dow Jones started the decade at just over 12,000 and today is at over 28,000. The S&P 500 started at 1,100 and today is at over 3,100. So very good returns for equity investors. Now I'm going to ask Rob Romano, our Director of Research, to join us and help me discuss the investment and equity outlook. Rob, thanks for joining me today as we talk about the 2020 outlook. As I just mentioned, the S&P and Dow are near their all-time highs. So how do we think about the equity markets as we go into 2020?
Well, we continue to be optimistic on the equity market heading into 2020, but believe returns are going to be well below what we've seen in 2019. Volatility will remain an issue with the uncertainty around trade, the elections, and global growth. Historically, the equity market has corrected 5% on multiple occasions in a given year, and also 10% at least once a year also. Our forecast, though, is based on the massive monetary policy accommodation we're seeing from the Federal Reserve and other central banks. 85% of central banks have lowered interest rates in 2019, and we believe the benefits from this accommodation will continue in 2020. Also, valuations are elevated, but not at extreme levels we've seen at previous market tops.
Where do we see valuations right now in the equity market?
The forward price to earnings ratio on the S&P 500 is roughly 18 compared to the historical average of roughly around 14 to 15.
So we're really not experiencing some of the euphoria that we've seen at previous market tops. Do we see any euphoria at all when it comes to equity markets?
Currently, we do not in this market. And one of our core investment principles is that we track measures of investor sentiment. And this has been a bull market that investors love to hate. Year to date, we've seen investors withdraw money out of mutual funds and exchange-traded funds on a combined basis, and those monies have made their way into fixed income. So that is more of a risk-off, more of a conservative investment strategy. Also, money market balances have increased significantly since 2009. So we don't believe this is the behavior you typically would see at a market top.
Rob, as always, we appreciate your comments on the equity markets, and we look forward to more comments in the future.
Thank you.
Now let's take a moment and look at the 2020 outlook for the economy. When it comes to the economy, we really are looking at 3 or 4 different pieces. First, we're going to look at the trade wars, we're going to look at corporate earnings, we're going to look at the consumer, and we're going to look at interest rates. When it comes to the trade war, this is truly the wild card as we enter 2020. While we're producing this video, currently the comments both from China and the United States are very positive and giving an optimistic outlook that there will be a trade deal shortly, which would help growth both in the United States and globally in 2020. If that deal were to fall through, that will greatly hinder the ability of the United States and globally to have economic expansion. So we'll be watching that very closely. When we look at corporations and corporate earnings, we do believe there will be a recovery in corporate earnings and corporate expenditures, but also there's a caveat that is partially hinged to the confidence that is tied to the trade wars. So we'll be watching corporate earnings very closely. The one piece that we believe will continue to drive the economy in 2020 is the U.S. consumer. The U.S. consumer today is seeing some of the best job growth and wage growth that we've seen in over 20 years. In fact, the U.S. consumer at a household level has higher income today than any time in history, even inflation adjusted. The second strength to the U.S. consumer is also the amount of debt service they have. If you look at their debt service payments to income, that's at nearly a 50-year low. So the consumer has the ability to see increases in their earnings as well as the ability to service debt. And since they make up 70% of the economy, that's a very good positive structure as we enter 2020. Lastly, what will help us continue the economic expansion in 2020 is the interest rate cuts that the Federal Reserve has done over the last several months. The Federal Reserve has dropped the interest rates 3 times, 0.25% each time. This is really a preemptive move to keep the economy growing as we enter the next year. Now I'm going to ask Eric Clapsaddle, our Senior Fixed Income Portfolio Manager, to join me and add some comments to the fixed income market. Eric, thank you for joining me on the 2020 Investment Outlook. When I think about a year ago and we were talking about fixed income markets, the Federal Reserve was about 4 years into rate increases, and the Federal Chairman Powell had said that, we're on autopilot, we're going to raise rates and shrink the balance sheet. And we basically have done a 180-degree turn since then. So can you talk a little bit about the Federal Reserve and then also what we see for interest rates now as we enter 2020?
Yeah, so to your point, rewinding back to 2018 and the previous years, we just think the Fed got a little overzealous in late 2018, raised rates probably 1 or 2 times too many. You saw that in 2018 as the markets got a little spooked and sold off in December of last year. So the first rate cut, maybe the second rate cut this year, was just to get them back to where they should have been in 2018. Beyond that, and probably more importantly, there's just been a lot of global uncertainty surrounding trade with China and other nations, and Brexit's still hanging out there. And really, actually, most importantly, the Fed believed that they could continue this economic expansion by keeping interest rates lower for longer, and so far, so good in 2019. As far as what we see in 2020, we actually think the Fed's going to take more of a wait-and-see approach. That's primarily due to a good economy, not great economy, but a good economy, and less uncertainty in trade. So what that means as far as rates go, short-term rates should be where they're at today. You can kind of see them around there for the remaining part of 2020, certainly through the election. And then long-term rates, they could shift up a little bit. Not much, but a little bit.
So, well, obviously, our rates in the United States have continued to stay positive. As we talked about earlier this summer, there's a lot of conversation about negative interest rates. And so we thought we'd just update our clients on kind of where negative interest rates are globally as we enter 2020.
Sure. So though a coincidence, we have seen since our video a lot of government bodies, political authorities, investment economic pundits speak to the lack of effectiveness of negative rates, not only for consumers and lending, but for banks. And it's bled into the negative yielding bonds and the total amount that are out there. We've seen negative yielding bonds drop from a cumulative 17 trillion down to slightly over 11 trillion. And that's about a third of negative yielding bonds in the world have been wiped out.
So, well, wiped out in the sense that they're now positive yielding, which is actually good for investors. Yep. Obviously, if you bought them, you've lost money, but going forward, there'll be at least positive returns for fixed income investors at that part of the market. Eric, as usual, really appreciate you sharing what we think about fixed income and interest rates as we enter 2020.
Thanks, Paul.
No 2020 investment outlook would be complete without some commentary about the election. When we go back and look over the election of the last 29 presidential cycles, generally speaking, the year in total for equity markets is positive. If the incumbent party wins the election, the markets are up even more, and if the incumbent party loses, they're up, but just not as much. Obviously, we still are in the early stages of the election and nomination process, so we really don't have a good idea of what we can expect from either party when it comes to the 2020 election. So our job right now is to keep understanding what the proposed programs might be, but really wait and take action once we know who the nominees would be, and even more importantly, who the next president would be. Regardless of what's going to happen in the presidential election, just like we have for over the last 100 years, First Source is continuing to work with our clients to help them achieve security, build wealth, and realize their dreams.